Hello, I'm your professor, Dr. Stephen Haggard, and in this video I'm going to talk to you about payout policy. The first thing we need to recognize is that excess cash at the firm does not belong to the managers. It doesn't even belong to the firm, because the firm is owned by the shareholders, and so the excess money or cash floating around at the firm actually belongs to the shareholders. Now, firms can return that excess cash, and by the way, let's talk about what is excess cash. Anything over and above that necessary to fund all positive net present value projects and the day-to-day operations of the firm, we could consider to be excess. And so the firm can actually return that excess money to the shareholders either through a dividend, which would be a periodic payment to the shareholders, or through what is called a share repurchase, where the firm actually buys back its shares. Now, my Chinese students point out to me quite often that this is actually not legal in China. I don't know if that's true or not, but it's certainly legal in the United States and in many nations around the world. The firms are perfectly able to repurchase their own shares on the open market. And both of these things put the money back in the hands of the shareholders. Now, let's keep in mind that the goal of financial management is to maximize shareholder wealth. And so, just like we do with everything else, we should aim our payout policy at maximizing the wealth of our common shareholders. And so, what are some of the things that we need to think about? Well, one of them would be taxes. Because of the different taxation rate for investors between dividends and capital gains, investors might prefer one to the other. In fact, when I first started studying finance, the dividend tax rate was the same as the personal tax rate. In other words, people were paying on dividends just like they would on interest or regular income. And that tended to be a higher tax rate than the capital gains tax rate. And so that made it clear that people, from a tax perspective, would prefer capital gains reaped through a share repurchase as opposed to dividends paid to them. But then in the early 2000s, we started taxing dividends and capital gains at the same rate. But capital gains would still have a positive option value compared to dividends, and here's why. With a share repurchase, I can choose whether or not to sell my shares, and in doing so, I'm choosing when I get that capital gain. If I don't want the capital gain right now, I don't have to take it, and therefore I don't have to pay taxes. On the other hand, when they send you the dividend in the mail, you can't refuse it. It comes to you and you cash the check and you must pay taxes on it. And so even if they are taxed at exactly the same rate, capital gains would have a timing advantage over dividends. Furthermore, as my dad likes to point out, if you manage to die before you sell your stock, you can avoid capital gains taxes altogether. Why is that? Because the investment basis for your heirs is the value of the stock on the day you die, even though that might be greatly inflated from what you paid for it many years ago. And so those capital gains would go untaxed, therefore making capital gains once again preferred to dividends from a tax perspective. And so that's one of the things we need to take into account. Now, another thing that we need to think about with dividends and repurchases is their ability to serve as a signal. There's information asymmetry between the firm's managers and investors. What do we mean by that? The firm's managers undoubtedly have more information about what's going on in the firm than investors do. And they cannot signal that information credibly without a cost. In other words, if they just stood up and said, "Oh, things are great, everyone should buy our stock," no one would believe them. I have seen CEOs go on CNBC and declare that everything was great with their firm, and within 24 hours the firm had declared bankruptcy. Remember, people are scumbags and we can't trust what they say. But in America we have an expression, put your money where your mouth is. If managers think that earnings are going to be higher going into the future, and that's going to be consistent and dependable, then they feel safe in raising the dividend. And doing so sends a strong signal about the manager's belief in the future of the firm. And why is it credible? It's costly to pay a dividend. It's not free. I can't just stand up and make a claim. There's actual money being put on the table. And bad quality firms can't replicate that signal. They might be able to do it once or twice, but if they're not bringing in cash, they can't continue to increase their dividends. And so payouts can be a credible signal of the quality of the firm. Now let's talk about what happens when a firm cuts the dividend. What this says is that managers are not confident in the firm's ability to continue to produce the current level of earnings. And as a result, what we will see is a negative stock price reaction to that announcement. By the way, there's a positive stock price announcement reaction for dividend increases, but there is a negative reaction to decreases. And in fact, that reaction is greater in magnitude. And so managers will be reluctant to raise the dividend, which will get them a modest increase in their stock price, because they know if they have to cut it, they will get punished at a greater magnitude on the stock price. And so what they tend to do is be conservative in raising dividends and reluctant to cut dividends. Therefore, we say that dividends are sticky. Now, what if the firm has excess cash that's as a result of maybe a one-time situation or a short boom period? Should the firm increase dividends? Probably not, because those additional earnings are not going to be going forward in perpetuity. And so instead, what they might choose to do is a share repurchase. Even though this is a signal that the excess of cash at the firm might only be temporary, share repurchases are still greeted with a positive stock price reaction. Now, beyond signaling, we see that there may be other reasons for firms to pay out. And one advanced by Jensen in 1986 is an agency explanation. Remember the agency problem, where agents are unlikely to act in the interests of the principals or owners of the firm. In other words, the managers are going to act in their own interest, not in the interest of the owners of the firm. And they will do things that the owners, the shareholders, would not want them to do. And one of the things that managers love to do is to grow the firm. Now that sounds good, but there are two ways you can grow the firm. You can either grow it in a way that increases shareholder wealth, and that's a way that we're all happy with. Or you can grow it in a way that destroys shareholder wealth. We call this empire building. Now, why would managers want to grow the company even though they were destroying shareholder wealth? Everybody knows that the CEO of a bigger company is more important and probably requires a higher salary and gets more respect and is listed higher in the Fortune 500, things like that. All sorts of things that managers might do with excess cash that don't bring value to the shareholders. Additionally, they might just waste the extra money. For instance, our Gulfstream G5 just isn't nice enough anymore. We need a Gulfstream G6. And I've actually seen this when I've been in companies. When times are good, we spend money wastefully. And we say things like, oh, we've got plenty of money. But is it our money? It's not. The money belongs to the shareholders. And paying out that money in the form of dividends or repurchases basically says we are committing not to waste your money, shareholders. And as a result, we might also expect that to lead to a higher share value for the firm because, after all, now shareholders know we are not going to undertake wealth-destroying acquisitions and wasteful spending with their money.